Let me tell you a story about a man who found religion. Not real religion, corporate religion. The kind of conversion that happens not because of spiritual awakening, but because the spreadsheet told him to convert. This man's name is Larry Fink, CEO of BlackRock, the largest asset manager on planet Earth. $9 trillion under management, more money than most countries' GDP. The kind of person who can move markets with a single sentence in an earnings call. In 2017, Larry called Bitcoin an index for money laundering. His exact words. You can look it up. He said it on CNBC. He said it with the kind of confidence that only comes from running a $9 trillion empire. Bitcoin was for criminals, for terrorists, for people trying to evade taxes, and buy drugs on the dark web. Not for serious investors, not for institutions, definitely not for BlackRock. Fast forward to 2024. Larry launches the iShares Bitcoin Trust, ticker IBIT, the largest and most successful Bitcoin ETF in history. Accumulated 500,000 Bitcoin in under a year. That's approximately $60 billion worth of Bitcoin at current prices. And in interviews, Larry doesn't call Bitcoin an index for money laundering anymore. Now he calls it digital gold. He calls it a flight to quality. He says it's a legitimate portfolio diversifier that every serious investor should consider. So what happened? Did Larry have a spiritual awakening? Did he read the Bitcoin white paper and suddenly understand the cypherpunk dream of decentralized money? Did he become a libertarian who believes in freedom from central bank tyranny? No, none of that happened. What happened was Larry's supercomputers ran the numbers, and the numbers said, buy Bitcoin, or you're committing financial malpractice. Let me explain. BlackRock uses a risk management system called Aladdin. Aladdin is not a person, it's a software platform, one of the most sophisticated portfolio analysis tools ever built. It manages approximately $21 trillion in assets across BlackRock and their clients. That's not a typo, 21 trillion. With a T, every major investment decision BlackRock makes runs through Aladdin first. Aladdin analyzes correlations, volatility, return distributions, drawdown risk, Sharpe ratios, every possible metric you can imagine and several you can't. And sometime around 2022, Aladdin started telling BlackRock something very uncomfortable. Portfolios without Bitcoin exposure were suboptimal, not slightly suboptimal, significantly suboptimal. Measurably, mathematically, undeniably suboptimal. This wasn't ideology, this wasn't speculation. This was modern portfolio theory, the same theory that won Harry Markowitz a Nobel Prize in 1990, the same theory that every institutional investor uses to construct portfolios. And that theory was screaming, add Bitcoin. Here's how it works. Modern portfolio theory says that the optimal portfolio is the one that maximizes return for a given level of risk or minimizes risk for a given level of return. You do this by combining assets with different correlation profiles. If two assets move together perfectly, they have a correlation of 1. If they move opposite to each other perfectly, they have a correlation of -1. If they move independently, they have a correlation of 0. The magic happens when you add an asset with low correlation to your existing portfolio. Even if that asset is volatile by itself, if it doesn't move in sync with your other assets, it can actually reduce total portfolio volatility while increasing returns. This is called diversification, and it's the only free lunch in finance. Bitcoin's correlation to traditional assets is approximately 0.2 to 0.3. It's not perfectly uncorrelated, but it's close. More importantly, during certain market stress periods, Bitcoin's correlation goes negative. When stocks crash, sometimes Bitcoin crashes with them, but sometimes Bitcoin pumps. It's unpredictable, which from a portfolio construction standpoint is exactly what you want. Unpredictable upside with limited downside correlation. Now here's where it gets interesting. BlackRock's quants, the math PhDs who run the models, started running simulations. They took a standard portfolio, 60% stocks, 40% bonds, the classic balanced portfolio. Then they ran a version where they took 3% from bonds and allocated it to Bitcoin, just 3%. The results were absurd. The portfolio with 3% Bitcoin had higher returns, obviously because Bitcoin outperformed bonds by a lot. But here's the part that made Larry pay attention. The total portfolio volatility barely increased. In some simulations, it actually decreased slightly. How was that possible? Because Bitcoin's low correlation meant that when stocks and bonds both dropped, Bitcoin sometimes went up, cushioning the blow. The portfolio became more efficient, higher return, same risk. That's the holy grail. That's what every portfolio manager spends their career searching for. And this wasn't theoretical. This was back-tested data from 2015 to 2023. Every single year, even the bad years when Bitcoin crashed 70%, adding a small Bitcoin allocation improved the portfolio's risk-adjusted returns. The Sharpe ratio, which measures return per unit of risk, went up. The Sortino ratio, which measures return per unit of downside risk, went up. The maximum drawdown didn't get worse and sometimes got better. Every metric said the same thing, add Bitcoin. So Larry, being a rational actor who manages $9 trillion for clients who demand performance, had a choice. He could ignore the math and stick with his 2017 opinion that Bitcoin was for criminals, or he could follow the math and build a Bitcoin product. He chose math. Not because he's a believer, because he's a fiduciary. And ignoring an asset that measurably improves portfolio outcomes is a breach of fiduciary duty. This is the thesis that nobody in the Bitcoin community wants to hear because it's not romantic. It's not about freedom or revolution or sticking it to the man. It's about sharp ratios and correlation matrices and value at risk models. It's about institutions doing what institutions always do, following the money. But here's the beautiful part. It doesn't matter why they're buying. It only matters that they are buying. Because every Bitcoin that BlackRock buys is one less Bitcoin available for everyone else. Let me give you some numbers. As of January 2026, BlackRock's IBIT holds approximately 520,000 Bitcoin. That's about 2.5% of all Bitcoin that will ever exist. And they accumulated that in less than 2 years. MicroStrategy, now officially rebranded as Strategy, holds about 640,000 Bitcoin. That's another 3%. Between just these two entities, they control 5.5% of the total supply. Forever. Grayscale still holds about 300,000 Bitcoin in their trust. Fidelity's FBTC holds another 300,000. Add in all the other ETFs, all the public companies that have added Bitcoin to their balance sheets, all the private funds, and you're looking at approximately 2 million Bitcoin locked up in institutional hands. That's 10% of the total supply. And this happened in the span of about 3 years. Now extrapolate. If institutions went from 0 to 10% in 3 years, where do they go in the next 5 years? 10% to 20%? 20% to 30%? And remember, this isn't a growing supply. This is a fixed supply. 21 million Bitcoin. 4 million already lost. 17 million actually available. Institutions already own 2 million. That leaves 15 million for everyone else, every country, every company, every individual, every pension fund, every sovereign wealth fund. 15 million Bitcoin to split among 8 billion people. Do the math. That's 0.001875 Bitcoin per person. Less than 2/1000ths of 1 Bitcoin per human on Earth. If institutions want more, and they clearly do based on the ETF flows, where does it come from? It comes from people who sell. And at what price do people sell? Higher prices. Much higher prices. This is not speculation. This is supply and demand. And the demand side is accelerating while the supply side is fixed and shrinking due to lost coins and long-term holders. BlackRock isn't buying Bitcoin because they think it'll go up 20%. They're buying Bitcoin because their models say it's mathematically necessary for portfolio construction, and they're willing to buy at any price that maintains their target allocation. Here's another data point that should terrify you if you do own Bitcoin. The accounting rules changed. In December 2023, the Financial Accounting Standards Board, FASB, approved new rules for digital asset accounting. Previously, companies that held Bitcoin on their balance sheet had to mark it down if the price fell, but they couldn't mark it up if the price rose. This created a perverse incentive where holding Bitcoin was an accounting liability, even if it was an economic asset. The new rules allow fair value accounting, mark to market. If Bitcoin goes up, you can recognize the gain. If it goes down, you recognize the loss. Symmetrical treatment. This might sound like a technical detail, but it's actually massive, because it removes the accounting penalty for corporate treasuries to hold Bitcoin. Before this rule change, a CFO who bought Bitcoin was taking career risk. If the price dropped, even temporarily, they'd have to explain to shareholders why they're holding an asset that's showing losses on the balance sheet. Now, price volatility is treated like any other marketable security. It goes up and down, and that's fine. This opened the floodgates for corporate adoption. Microsoft shareholders voted on whether to add Bitcoin to the balance sheet. It failed, but the fact that it was even proposed and got 40% support is significant. Apple is rumored to be studying it. Amazon is studying it. Every major corporation with significant cash holdings is at least looking at it, because the opportunity cost of holding 0% Bitcoin is becoming larger than the risk of holding some Bitcoin. And this is where the game theory gets really interesting. When you're a corporate treasurer sitting on $10 billion in cash, your job is to preserve purchasing power. Traditionally, you did this with treasury bills. Safe, liquid, backed by the full faith and credit of the United States government, but treasury bills yield about 4%, while real inflation runs at about 8 to 10%. You're losing 4 to 6% per year in purchasing power. That's not acceptable. You could buy stocks, but stocks are volatile and correlated with your business operations. If the economy tanks and your stock portfolio crashes at the same time your sales decline, you're doubling down on risk. You could buy gold, but we just covered why gold is a trap. You could buy real estate, but that's illiquid and requires management. Or you could buy Bitcoin. Volatile, yes, but uncorrelated. And if your competitors buy Bitcoin and it goes up, they'll have stronger balance sheets than you. If you don't buy Bitcoin and it goes up, you'll be at a competitive disadvantage. This is the prisoner's dilemma of corporate treasuries. The first company to buy Bitcoin takes reputational risk, but if Bitcoin works, they have a stronger balance sheet. The second company to buy Bitcoin takes less reputational risk because someone else went first, but they pay a higher price. The 100th company to buy Bitcoin takes almost no reputational risk because it's standard practice by then, but they pay the highest price. The game theory optimal move is to buy early, even if it feels scary, because waiting is more expensive than being wrong. MicroStrategy figured this out in August 2020. Michael Saylor, the CEO, put $425 million of corporate treasury into Bitcoin when the price was around $11,000. Everyone called him crazy. CNBC had segments about how he was destroying shareholder value. Analysts downgraded the stock. But Michael didn't care because he understood the game theory. He understood that if he was right, MicroStrategy would outperform every other software company in the world. And if he was wrong, the company would still exist and operate normally. Fast forward to January 2026. MicroStrategy's Bitcoin holdings are worth approximately $76 billion. The company paid about $22 billion for those coins. That's a $54 billion gain. The company's market cap is now higher than companies 3 times its size in revenue because the market values the Bitcoin on the balance sheet. Michael wasn't crazy, he was early. And early looks like crazy until it doesn't. Now every CEO is looking at MicroStrategy and thinking, should we do that? And the answer from the Aladdin models is increasingly yes. Not because Bitcoin is going to change the world, not because it's going to replace the dollar, but because it is an asymmetric bet with limited downside and unlimited upside that's uncorrelated to traditional business risk. That's Corporate Finance 101. You take those bets every time. Let me give you Larry Fink's actual quotes because they're illuminating. In 2017, Bitcoin is an index for money laundering. In 2024, Bitcoin is digital gold. It's a flight to quality. It's an international asset that can transcend any one currency. What changed? Did Bitcoin become less useful for money laundering? No. If anything, blockchain analysis made Bitcoin worse for criminals because every transaction is permanently recorded on a public ledger. What changed was the institutional infrastructure. ETFs, custody solutions, regulatory clarity, the ability for institutions to buy Bitcoin without touching the underlying complexity. And here's Larry in a recent interview. I believe Bitcoin is a legitimate financial instrument that can serve as a store of value and a diversifier in portfolios. Whether you believe in the technology or the philosophy doesn't matter. What matters is what the numbers show, and the numbers show that Bitcoin improves portfolio outcomes. That last sentence is the key. Whether you believe in the technology or the philosophy doesn't matter. Larry doesn't care about Satoshi's vision. He doesn't care about decentralization or censorship resistance or freedom from government control. He cares about Sharpe ratios. And the Sharpe ratio says buy Bitcoin. So BlackRock buys Bitcoin. And when BlackRock buys, everyone else follows. Here's the flow data. In the first year of operation, the Bitcoin ETFs collectively accumulated approximately 800,000 Bitcoin. That's 4% of the total supply in 12 months. The daily inflows are insane. On January 2nd, 2026, IBIT alone saw $287 million of net inflows in one day. Where does that Bitcoin come from? It comes from miners selling. It comes from early holders taking profits. It comes from exchanges and over-the-counter desks. But mostly, it comes from supply that will never hit the market again because institutional holders do not sell. They accumulate. BlackRock's investment time horizon is decades. Pension funds are buying Bitcoin to match liabilities 30 years out. Sovereign wealth funds are buying Bitcoin as a multi-generational store of value. These are not traders. These are accumulators. Every Bitcoin they buy gets locked up for years, potentially forever. And as the available supply shrinks, the price has to rise to incentivize existing holders to sell. This is Econ 101. Demand increases, supply is fixed, price adjusts. But wait, it gets better. The halving dynamics supercharge this. Every 4 years, the Bitcoin mining reward gets cut in half. In April 2024, the reward dropped from 6.25 Bitcoin per block to 3.125. The next halving is in 2028, dropping it to 1.5625. By 2032, it'll be 0.78125. The issuance rate is declining exponentially, while institutional demand is increasing exponentially. This is the supply squeeze everyone predicted, but few actually believed would happen. And it's happening now. We're watching it in real time. The ETF inflows are absorbing more Bitcoin per day than miners produce. Let me say that again. Institutional demand exceeds new supply. Every single day, more Bitcoin is bought than mined. The deficit has to come from existing holders selling, but existing holders are increasingly institutions themselves. Who don't sell? See the problem? This is the vortex. This is the doom loop. but the good kind of doom loop. Institutions buy, supply shrinks, price rises, more institutions notice, more institutions buy, supply shrinks further, price rises more. It's a positive feedback loop. And the only thing that can break it is a massive sell-off from existing holders. But why would they sell when institutions are bidding up the price? Here's what's going to happen next. I'm not predicting. I'm extrapolating. More companies will add Bitcoin to their balance sheets. Not because they're true believers, because their competitors did it and outperformed. More sovereign wealth funds will allocate, not because they love Bitcoin, because the returns are too good to ignore and the opportunity cost is too high. More pension funds will add Bitcoin exposure, not because they want to, because their actuaries ran the numbers and said it's mathematically necessary to meet their liability obligations. And every step of this process removes more Bitcoin from circulation, permanently. You cannot get these Bitcoin back except at much higher prices. And the higher the price goes, the more reluctant institutions become to sell because the unrealized gains look good on their balance sheets and their boards ask, why would we sell the best performing asset we own? Now, let me address the elephant in the room. You're thinking, this sounds like a Ponzi scheme. The price goes up because people are buying, and people are buying because the price goes up. And I get it. That's exactly what it looks like. Except there's one crucial difference. The supply is fixed. In a Ponzi scheme, the operator can create infinite supply to meet demand. In Bitcoin, no one can create more supply. Not even Satoshi, not even all the miners combined. The protocol limits supply to 21 million, and that's mathematically enforced by the network. So yes, the price is going up because people are buying. But people are buying because they recognize that an asset with fixed supply and growing demand will increase in value. That's not a Ponzi, that's supply and demand. The same mechanism that determines the price of beachfront property or vintage wine or literally any scarce asset. The difference is, Bitcoin's scarcity is perfectly inelastic. No matter how high the price goes, no one can mine more Bitcoin faster. The issuance schedule is fixed. This is why institutions are buying, not because they think they can flip it to a greater fool, but because they recognize that an asset with provable scarcity and growing institutional adoption is fundamentally undervalued relative to its future ubiquity. They're not speculating. They're positioning. There's a difference. Let me give you the final piece of the puzzle. The generational wealth transfer. Baby boomers currently control approximately $68 trillion in wealth. That's wealth accumulated over 50 years of working, saving, and investing. Over the next 20 years, that wealth transfers to Gen X and millennials through inheritance. And guess what? Gen X and millennials don't want gold. They don't want bonds. They don't trust traditional institutions. They grew up during two financial crises, watched their parents lose their homes, watched their governments bail out banks, and watched their purchasing power evaporate through inflation. What they do trust is technology, and Bitcoin is the only financial technology that doesn't require trusting a bank or government. When $68 trillion starts moving from boomers who love bonds and gold to millennials who love Bitcoin and tech stocks, where do you think that money flows? Not all of it, not even most of it. But even if 1% of that wealth transfer goes into Bitcoin, that's $680 billion of new demand hitting a fixed supply. The math is inevitable. BlackRock knows this. Every major institution knows this. That's why they're buying now instead of waiting. They're front-running the generational wealth transfer. They're accumulating before the millennials inherit and allocate. This isn't speculation. This is positioning based on demographic certainty. The wealth is transferring. The preferences are different. The flows are coming. Be early or be late. There's no in-between. So when people ask me, why is BlackRock buying Bitcoin? I tell them, because the math says they have to. Because their models show it is the only asset with the risk-return profile to solve modern portfolio construction problems. Because the opportunity cost of zero Bitcoin exposure is higher than the risk of having Bitcoin exposure. Because their competitors are doing it. Because the generational wealth transfer is coming. Because the supply is fixed and the demand is exponential. They didn't buy Bitcoin for ideology. They bought it for math. And the math is undeniable. And if you're sitting there with zero Bitcoin exposure thinking, I'll wait until it's safer, you're making the same mistake Frink made with gold. You're choosing comfort over returns. And comfort is expensive. The institutions are buying. The corporations are buying. The sovereign wealth funds are buying. What are you doing? The train is leaving the station. Larry Fink is on it. Michael Saylor is on it. The pension funds are on it. The sovereign wealth funds are on it. You can get on now at $120,000 per Bitcoin. Or you can wait until everyone agrees it's safe and get on at $1 million per Bitcoin. Your choice. Choose wisely.